A milestone for the overhaul of the global tax system.
On the 1st of July 2021, the world celebrated a landmark moment.
130 countries have backed plans for new rules to tax companies at a rate of at least 15%.
4 years later, the fine print is signed and the world is watching as countries begin to implement the deal. But how did we get here? What forced the old tax rules to finally change? And will it all actually work? This is the second part of the 15% solution, 2 episodes examining plans to reform the global tax system. I'm Gemma Ware, and this is The Conversation Weekly, the world explained by experts. Telling this story for us is Mend Marwani, one of the producers of our show. Hello, Mend.
Hi, Gemma.
So this global tax deal from the Organisation for Economic Cooperation and Development, the OECD, it's been years in the making. And now this idea for a global minimum tax for multinational companies is finally being rolled out across a variety of different countries. What's the goal of this whole endeavour?
Yeah, so the goal of this tax framework is to end what's called the race to the bottom. That's where corporations pit countries against each other to pay less tax. So what they do is they shift profits to places with almost zero tax rates.
And I remember when this deal was announced, it felt like quite a big breakthrough moment.
Yeah, it really was. And this is a problem that developing nations have been complaining about, at least since the 1990s. Every time a company funnels profits into a shell company, countries then lose out revenue that they could be using for schools, for hospitals, infrastructure, etc. And so the OECD's plan now is really the first real attempt to force companies to pay taxes where they do business instead of just where they're registered.
Okay, so I'm handing over to you again for this episode. Where did you start trying to find out how we got to this point?
I first wanted to understand exactly how the OECD's tax deal works. And so I reached out to Martin Heersen. He's a research fellow at the Institute of Development Studies in the UK. He studies especially how lower income countries navigate international tax negotiations. But first, I asked him about some history.
The UN had a first crack at being the primary institution in global tax governance in the 1950s. But at that point, it wasn't able really to find a purpose. And so that work fizzled out.
After World War II, companies and private investors increasingly began investing and operating across borders. As a result, global leaders knew there needed to be rules about how to tax businesses. But the UN struggled to build consensus. Meanwhile, another organization was gathering momentum, the OECD, essentially a club of 38 rich countries that makes global economic rules. In 1961, the OECD launched its first model tax convention, a framework designed to make sure companies wouldn't be taxed twice on the same income. It was after that the UN took note again.
The UN started to engage again in the late 1960s, early 1970s, on this technical level through this committee of experts, looking at what was being done by the OECD and asking, how should we adapt this to suit the interests of lower income countries? And that work was first crystallized in a model convention published in 1980. What's happened in the past 2 decades has been more intense politicization in international tax.
As globalization accelerated in the 1990s, so did the scale of tax avoidance. A quick reminder, tax avoidance refers to the legal use of loopholes or laws to one's benefit, to avoid paying taxes as much as possible. Tax evasion, on the other hand, is the practice of illegally avoiding taxes by hiding or laundering money. And so in the 1990s, a number of economists in richer countries had sounded the alarm about how offshore tax havens were draining national budgets. In 1998, the OECD responded, publishing a landmark report on harmful tax practices inside and outside member countries. According to the report, some of these practices are especially damaging. They include low or no taxes on corporate income, lack of transparency, and bad exchange of information between economies. Eventually, in 2013, the OECD, backed by the G20, launched the Base Erosion and Profit Shifting, or BEPS project, an initiative to reform international tax rules to curb aggressive tax avoidance by multinational corporations.
That's pushed for a much more intense scrutiny of what happens internationally in domestic politics, but it's also created much greater disagreement between states.
During the BEPS negotiations, it became increasingly clear that it was only OECD member countries, mostly rich countries, that had a real say in global tax negotiations. In response to that criticism, in 2016, the OECD created a new initiative to include non-member countries in its negotiations too.
So that further created a sense that lower-income countries should be able to actually influence what happens. But what they found when they went into the OECD was that they weren't actually able to shape things as much as they hoped, because the OECD bodies were still dominated by the interests of the OECD member states and other large economies. So that growing frustration on the part of low-income countries is what's led to the desire to create a new vehicle through which they can pursue their own priorities.
Lower income countries wanted a voice, but the OECD decision-making process still remained dominated by richer countries. It was two seismic shifts that then turbocharged calls for more radical reform.
Panama documents giving unprecedented insights into how and where the world's rich and powerful stash their cash.
A huge leak of more than 13 million documents, dubbed the Paradise Papers, shows how the world's super rich elite shelter their wealth in secretive tax havens.
Leaks like the 2016 Panama Papers and 2017 Paradise Papers exposed how rich people, including owners and CEOs of multinationals, exploited offshore loopholes on a massive scale. At the same time, the growth of digital services was making it clear that old tax treaties were no longer fit for a borderless global economy.
And now you have the proposed Framework Convention, which is being seen as a way of filling that vacuum.
So, Mend, this framework convention that Martin's talking about, it's the one we heard about at the top from the OECD, this one that we've just had adopted. Where are we actually, though, with this global tax deal right now? Is it actually happening?
Yeah, it really is. As of February 2020-25, 135 countries agreed on the final details of the rules. But actually, countries have already started rolling out the framework little by little since last year. In October 24, Brazil signed an executive order. In December, the UAE then announced that it was implementing the rules as well. And in January this year, South Africa joined in too.
So is it kind of building momentum gradually, but different countries are adopting it?
Exactly. The rollout also isn't uniform. So each country is moving at its own pace. And some are also building in their own carve-outs and exceptions. So while the framework is global in theory, in practice, it's really a sort of patchwork of policies and agreements.
And I feel we're deep enough in here to get a little bit technical. So what is the global tax framework actually trying to do?
Yeah, at its core, the OECD created a two-pillar system to change how multinationals are taxed around the world. There's pillar one, and that's about where companies pay tax. So, for example, if a company sells millions of dollars in adverts to users in Ghana, but is officially registered in Luxembourg, in the past, Ghana wasn't able to tax those profits. Under Pillar 1, now it can, even if the company doesn't have an actual physical presence in that country.
That feels like quite a big shift.
Yeah, it really is. And then there's also Pillar 2, which is about how much tax companies pay. If a multinational has more than 850 million US dollars in annual revenue, it now has to pay at least 15% in tax. And it doesn't matter where it shifts its profits to.
So is the whole world agreed on the trajectory of this plan and everyone thinks it's a good idea?
Yeah, so for a moment, it really looked like the world had agreed on a common global plan. But just as momentum was building, the US, which is the world's largest economy, stepped back. Here's Martin again for his take on what's happening.
I think we're at a point when it's quite hard to call what's going to happen. So you had this deal developed at the OECD, the part on taxing the digital economy, which required everyone to agree and was primarily about taxing US and some other countries, but primarily US multinationals more. So it was always a game of trying to get the US to agree to something which would allow other states to tax American multinationals. That was always going to be difficult. It was inspired by actually tax laws introduced by the first Trump administration. So that felt like it had more prospect of succeeding.
In 2017, under Trump's Tax Cuts and Jobs Act, the US introduced a new rule called the Global Intangible Low Taxed Income. It's basically a minimum tax of 10% on the overseas profits of US multinational companies, and it's still in place today. For the first time, a major economy was saying, if you don't pay enough tax abroad, we'll tax you back home. And yet, since arriving into the White House for a second term, Trump has left the OECD's global tax deal negotiations by executive order.
I think what's complex about it right now is that the Trump administration is actually now getting quite militantly opposed to some aspects of the design of the minimum tax.
The current Trump administration is refusing to sign Pillar 2 of the OECD deal. So that's the 15% tax. The US had already begun backtracking under President Joe Biden, but the OECD framework has a sort of built-in safety net.
The genius of the global minimum tax is that it doesn't require everybody to agree on it in order for it to work. A smaller number of large economies can make it a reality by moving together.
If a multinational pays less than 15% tax in any country, other nations where it operates can charge a top-up tax to reach that minimum 15%. Take a company that reports profits in Bermuda, where taxes are 0%. If the company operates in, say, France or Germany, these countries can claim their share of that missing 15% without the need for Bermuda's cooperation. So even if some countries like the US don't participate, as long as enough major economies enforce these rules, companies can't escape paying at least 15% somewhere. That's what makes this system self-enforcing. It works even when some countries opt out.
If the US doesn't adopt certain bits, then other countries will claim the tax revenue the US would have claimed. And that's the part that the Trump administration's unhappy with. What we're waiting to see is exactly how militantly the Trump administration will push back against that, because the EU is in this situation where they are now locked into adopting it. There's a directive which has been approved. The member states are translating it into law. It needs unanimity to unwind that. And unanimity is very difficult to find in EU tax matters. So it would be really interesting to see this strategic game right now in terms of the interaction between what happens in the OECD, between the member states and within the EU. And the EU countries is the driving force there. So it will come into effect if those countries adopt it, which they are now doing. But because of that self-enforcing mechanism, it means that the countries that didn't want to be part of it have no choice, because it's going to be adopted whether they like it or not.
Martin says this creates a new kind of pressure. Countries that don't adopt the rules still have to respond to them, or they risk losing revenue to those that do. For now, other than the US, countries that aren't implementing the framework include China, which supports the OECD's framework in theory, but isn't rushing to fully implement the minimum tax domestically. Russia has been excluded from the OECD negotiations, and many low and middle income countries like Kenya, Nigeria, and Pakistan also haven't subscribed. That's because Kenya has introduced its own digital service tax. Nigeria has criticized the deal as being skewed towards higher income countries. And Pakistan has said that the rules are too technical and that it doesn't have the capacity to implement them. But even if a country doesn't adopt the rules of the OECD tax framework, it cannot simply ignore them.
They have to adopt a response to it. They have to adopt particular bits of the institutional design that will enable them to be the ones that get the tax revenue, rather than the tax revenue just being accrued by the countries implementing the minimum tax, the leaders in the EU and elsewhere.
If a country refuses to adopt the 15% minimum tax, it could lose out on revenue entirely. The rules let compliant nations claim taxes that could have gone to the holdouts instead. So a 0% tax rate in a country like Bermuda becomes useless. Other countries will just take that 15% instead.
So it's closing down some of countries' autonomy over their tax policy. And sometimes in ways where we might say that doesn't feel terrible, because they were using that autonomy to engage in this race to the bottom to compete for inward investment. But on the other hand, it still is a question of tax sovereignty, which feels uncomfortable.
Despite the hurdles and challenges, in a statement released in April 2025, the OECD said that nations involved in the global tax negotiations have agreed to remain committed. It said, member countries recognized the critical importance of securing certainty and stability in the international tax system, in particular with respect to the implementation of Pillar 2 and the ongoing Pillar 1 negotiations. In late April, the Financial Times reported that conversations are still ongoing between the OECD and the Trump administration on finding a way for the US to adopt the deal. But further reporting by Politico suggested the EU could be open to further negotiating the terms of the deal to avoid retaliation from the US. The OECD expects about 80% of previously low-tax profits to now be properly taxed as a result of its framework. But at the heart of this story is a deeper question. Who gets to write the rules of the global economy? And whose interests do those rules serve? For many low and middle income countries, the OECD framework, in spite of its promises, doesn't just come with benefits, it comes with complications and costs.
Two of the main challenges that lower income countries face when they adopt international standards, and here we're talking largely about taxing multinational companies, cross-border investors, are the inbuilt bias that you see in rules that have been agreed by OECD countries. The international norms that have been propagated by the OECD countries, they make it harder for the countries in which that takes place to tax the profits that are made. So that's the first category of issues. The second is around complexity. So as well as the inbuilt bias in the rules also are increasingly complex. Lower income countries in their domestic tax laws tend to have fairly simple rules that say, well, if you make a payment of this kind, this is how much we'll tax it at. The approach preferred by the OECD states is far more complex. There are reasons why they prefer that approach, but it does presume a level of administrative and legal capacity that most lower income countries don't have and probably don't have much prospect of developing. So that means they tend to get caught in disputes with very well-resourced multinational taxpayers around the application of these rules, when if they had stuck to their own simple domestic law, it would have been more clear-cut.
In other words, for countries with fewer lawyers and legal resources, even good rules can backfire. And that's a recurring theme. The global tax system is being redesigned, but not always in ways that work for countries with fewer resources. That's why even as the OECD rolls out its plan, some countries are looking elsewhere, to the United Nations.
Countries at the United Nations voted for the organization to take a greater role in international tax matters.
Negotiations for the UN's Framework Convention on International Tax Cooperation officially began in February 2025.
The resolution was led primarily by African member states and could eventually move decision-making on global tax rules from the OECD to the UN.
The convention aims to create a fairer, more inclusive platform on international tax cooperation and to close gaps that prevent many countries from collecting tax revenues, even with the OECD's framework.
So I think actually the single biggest determinant of what will happen with the UN convention and maybe with the whole global tax regime complex right now is the extent to which countries in the global south are able to formulate their own agenda and form coalitions around it. So at present, the Framework Convention could change the dynamic of negotiation in a way that could empower the global south. I think it will be interesting to see what emerges. But the most fundamental question from my perspective is the extent to which countries are going to pursue objectives in the UN on which they can achieve a consensus, and the extent to which actually the UN is going to prove a vehicle through which smaller groups of countries that have a sense of common agenda can work together, knowing that some other countries will not join and will not support.
Whether it's the UN or the OECD or any other kind of global tax framework, what do you think can be done to actually make global taxation fairer and more effective?
I'd just like to make sure we're clear that it's not like the OECD hasn't had some significant successes which can benefit lower income countries. The OECD has brought into being this mechanism of exchange of information, which has great potential for all countries. And we've seen significant benefits for not just higher income countries, but also some lower income countries from participating in that already. Are there ways it could be designed which are more friendly to lower income countries? Yes. But should we throw that out because it's designed by the OECD? Absolutely not. And I think that's the perspective from many of the advocates of the UN Convention. They want to see an overarching body which consolidates existing work, including work by the OECD. If we look at the history of not just international tax cooperation, but also the way countries build their own tax systems. A reformist approach is really all you've got, because it is so difficult to tear up a set of institutions in which so many states and so many individuals have a vested interest and replace them with something from scratch. What's much more likely to happen is a gradual change.
Thank you, Martin, for joining us. It's been a pleasure talking to you.
You're welcome. Thanks for having me.
We'd like to thank all the academics who helped make this series possible, especially Irma Mosquera Valderrama for how her vital insights into the OECD's tax framework operates in practice. This two-part series was written and produced by me, Mend Meriwani, with sound design by Eloise Stevens. Our theme music is by Nita Sal, and Gemma Ware is the executive producer. If you'd like to get in touch with us, you can email us directly at podcast@theconversation.com. You can sign up for The Conversation's free daily newsletter by clicking on the link in our show notes. The Conversation is a non-profit news outlet dedicated to sharing the work of academic experts with a wider audience. If you like what we do, please support us at donate.theconversation.com. And please rate and review the podcast wherever you follow us. Thanks for listening.